Hey guys, Ken Boyd with the Accounting Accidentally website, where you'll find over 400 blog posts on the blog and also 350 links to the YouTube videos on accounting that you'll find linked on the site here. So I wanted to talk about Tesla and its fall, October of 2020. Tesla delivers 139,300 vehicles in the third quarter. They're trying to deliver 500,000 cars in 2020. Tremendous growth and tremendous ramp up in production, which brings up a few issues. Tesla is rapidly expanding production. Adding more production means large amounts. I'm going to change this to variable. We're going to talk about variable overhead costs. And the question is, how does all that variable overhead, that is costs that cannot be directly tied to the product, how does all that variable overhead get allocated to the products, which in this case are Tesla cars? So let's think about that. I'm going to go over to Excel. This is a method I've used to explain variable overhead analysis, okay? So before I go through the numbers, and I won't go through all of them, but most of them, you'll see that we have overhead incurred on the left. This is the check that we actually wrote based on hours times some sort of rate. On the right, we have the flexible budget for standard hours, which is what we expected, what we planned on. And in the middle, we have a combination, the flexible budget at actual hours. You'll see that in the middle, we use actual hours from the left. We use standard variable overhead on the right. So this middle column is a combination of the columns on the left and the columns on the right. And it's important to note that the cost driver, the thing that causes you to incur costs when it comes to variable overhead, are typically measurements like machine hours, labor hours, or processing time. We need some sort of activity level to allocate overhead because, again, overhead cannot be directly applied to production. So let's start on the right here. You'll see we've got some sort of standard hours that we expected when we budgeted times actual units produced, and that's how we get 2,400. Our rate, our variable overhead rate, is standard cost divided by standard hours. In the interest of time, I won't go into all the math, but you'll see that that $15 comes from the calculation a little further down the page, and it's something called a predetermined overhead rate. And this rate is calculated before any of the actuals are known, which is why we use standard. We don't know what the actuals are yet. So in this case, we come up with a flexible budget for assigning variable overhead of 36,000. The numbers on the left, as I mentioned, are actual numbers. That's what we actually incurred. That obviously happens after we budget. And what we have in the middle is the flexible budget for variable overhead at actual hours. So we use actual hours, 2,000, corresponds to what's in black. The standard variable overhead rate is 15, corresponds to what's in blue right here. And you'll see that we multiply down and we have 30,000. And we have variances. We have a spending variance, we have an efficiency variance. And the way to think about it is a spending variance has to do with a higher rate per unit than you expect. An efficiency variance has to do with the number of units or hours or activity. Okay. Before you even look at the variance amount, you'll see that the actual rate of 20 is more than the standard rate of 15. So it's not surprising that we have an unfavorable variance. Actual rate per hour is more than the overhead rate per hour. Happens to be 10,000 unfavorable. We spent more than we thought we did. We spent more than we expected by $10,000 unfavorable. In the efficiency variance, our flexible budget in the middle expected 2,000 hours. What we actually budgeted for was 2,400 hours. So if I take the difference there and I click on it, that's a favorable variance because we spent less, 30,000 in the middle in blue, than we expected in red, 36,000. So the total variance is the combination of the two. Efficiency variance favorable in red versus spending variance unfavorable in blue. We get a total variance of 4,000, which happens to be favorable, which happens to be unfavorable because unfavorable is greater than favorable by $4,000. This I have found is the best way to set up an overhead variance if you're answering a question. So that is a variable overhead variance example. If you go back to accounting accidentally and you click on the Get It Now button or on the free downloads, what you'll find is I'm up to 23 spreadsheets now that explain accounting topics. And what you'll receive is you'll see that the 23 spreadsheets are grouped together by topic, advanced cost accounting, etc. What you see here in the middle is an example of the spreadsheet. You'll get the YouTube video that goes with the spreadsheet so you can use it to answer test questions or practice for homework. All you need to do is email me at ken@stltest.net. I'll send you a link from my cloud backup Hightail, and you can download the spreadsheets one at a time or all at once. Thanks for watching, and we'll see you next time.